Hello, good day everyone. We are from Group 8 Financial Derivative course wanted to present about option-based strategy analysis using Malayan banking Berhad. Let's meet our teammates.
Hey Doctor, for our financial derivatives assignment, our group selected Malayan banking Berhad or Maybank for our option strategy analysis. Maybank is the largest bank in Malaysia and one of the leading banking groups in Southeast Asia. The company provides various financial services such as commercial banking, investment banking, Islamic banking and asset management. We selected Maybank because it is a well-known blue-chip stock with stable performance, but its share price is still influenced by economic conditions and interest rate movements. This makes it suitable for analyzing option-based strategies. For our market view, we expect Maybank stock price to experience moderate volatility with uncertain price direction. Although Maybank is generally stable, factors such as interest rate changes, inflation, economic conditions, and investor sentiment may cause price fluctuations. Since the direction of movement is difficult to predict, our group selected an option strategy that can benefit from significant price movement in either upward or downward direction.
Hi, good day everyone. Today I will be presenting the strategy overview and justification for our analysis of Maybank's financial derivatives. Our chosen strategy is a volatility neutral long straddle. In simple terms, this involves the simultaneous purchase of an at-the-money call option and an at-the-money put option. We have selected a strike price of RM11.16, which aligns with the Maybank's current market position. The primary objective here isn't to guess if the price will go up or down, but rather to bet on the movement itself. By paying a total premium of RM70, we achieve three things: directional independence, B. Profit whether the market rallies or crashes, cap risk. Our maximum loss is strictly limited to the premium paid, meaning no black swan event can wipe out more than our initial investment. And lastly, volatility capture. We are positioned to benefit from mega expansion, essentially when the market gets nervous or excited. The value of our position increases. Okay, moving on to strategy justification. Why the long straddle fits Maybank's profile? Maybank is the heavyweight of the KLCI and is highly sensitive to macroeconomic triggers. We identify three core reasons for this justification. First, macro sensitivity. Maybank's stock price reacts sharply to Bank Negara Malaysia's OPR decisions. With interest rate environments currently shifting, volatility is expected. Second, directional uncertainty. Currently, the market is sending mixed signals. Instead of taking a high-risk gamble on a bull or bear trend, the long straddle allows us to remain market neutral. Finally, let's look at the risk-reward profile. Our break-even points are mathematically defined. If the stock price rises above 11 ringgit 86 cents, our call option drives the profit. If it drops below RM10 ringgit 46 cents, our put option protects and retains the value. In conclusion, this strategy provides a vital safety net. It limits our downside to a known amount while ensuring we have unlimited upside potential during major market shifts. Thank you.
The current stock price as of April 2026 is 11 ringgit 16 cents. Looking at the recent price action, Maybank has declined from about 12 ringgit 40 cents to 11 ringgit 16 cents. That's roughly a 10% drop over 2 months. This decline creates uncertainty. Will Maybank bounce back up or will it continue falling? Because the direction is unclear, we choose a strategy that profits from big moves in either direction. The strategy we selected is a long straddle. Our market view is neutral, but we expect high volatility. We chose this strategy because it profits from significant price movement, whether the stock goes up or down. It captures volatility expansion without needing to predict a direction. This is perfect for Maybank's current situation where the stock could either rebound or drop further. Here are our key assumptions. We set the strike price at 11 ringgit 16 cents, which is at the money or equal to the current stock price. For premiums, we assume the call premium is 35 cents and the put premium is also 35 cents. This is approximately 3.1% of the stock price, which is reasonable for at the money options. The total cost of the strategy is 70 cents, which is the sum of both premiums. We assume a 3-month time to expiry, which is a standard option cycle. Now, let's calculate the break-even points. The total premium cost is 35 cents plus 35 cents, which equals 70 cents. The upper break-even is strike price plus total premium, 11 ringgit 60 cents plus 70 cents equals to 11 ringgit 86 cents. The lower break-even is strike price minus total premium, 11 ringgit 16 cents minus 70 cents, which is equal to 10 ringgit 46 cents. This means Maybank must move above 11 ringgit 86 cents or below 10 ringgit 46 cents for us to become profitable. Anything between these 2 points results in a loss. Here are the payoff formulas for our long straddle and expedition. If the stock price is above the strike price of 11 ringgit 16 cents, The call payoff is stock price minus strike price. The put payoff is 0 and net profit or loss is that amount minus the total premium of 70 cents. If the stock price is below the strike price, the call payoff is 0. The put payoff strike price minus stock price, and again we subtract 70 cents. If the stock price equals the strike price exactly, both payoffs are 0 and we lost the full premium of 70 cents. This is our maximum loss. Here is our payoff table showing 5 different scenarios at expiration. In the strong down scenario where Maybank falls to 10 ringgit, the put payoff is 1 ringgit 16 cent. After subtracting our premium cost of 70 cent, we make a profit of 46 cent. In the moderate down scenario at 10 ringgit 80 cent, the put payoff is only 36 cent, which is less than our premium cost. So we lost 34 cent. At the flat scenario, where the stock stays at 11 ringgit 16 cent, both payoffs are 0 and we lost the full 70 cent. In the moderate up scenario, at 11 ringgit 52 cent, the call payoff is 36 cent, again less than the premium, so we lost 34 cent. Finally, in the strong up scenario, at 12 ringgit 32 cent, the call payoff is 1 ringgit 16 cent, giving us a profit of 46 cent. Now, let me walk through one calculation in detail. For the strong down move, where the stock price falls to 10 ringgit, the downside movement is about 10.4%. The call payoff is 0 because the stock is below the strike price. The put payoff is 11 ringgit 16 cent minus 10 ringgit, which equals 1 ringgit 16 cent. Total payoff is 1 ringgit 16 cent. Subtracting the premium cost of 70 cent gives us a net profit of positive 46 cent. For the moderate down move to 10 ringgit 80 cent, the downside movement is only 3.2%. The call payoff is 0. The put payoff is 11 ringgit 16 cent minus 10 ringgit 80 cent, which equals 36 cent. So the total payoff is 36 cent. After subtracting 70 cent, we get a loss of 34 cent. This happens because the stock didn't move enough to cover our premium cost. At the flat scenario, where the stock price stays exactly at 11 ringgit 16 cent, there is no movement at all. Both the call and put payoffs are 0. So the total payoff is 0. We lost the entire premium we paid, which is 70 cent. This is our maximum loss for the long straddle strategy. For the moderate up move to 11 ringgit 52 cent, the upside movement is 3.2%. The call payoff is 11 ringgit 52 cent minus 11 ringgit 16 cent, which equals 36 cent. The put payoff is 0. So the total payoff is 36 cent. After subtracting 70 cent, we again lost 34 cent because the move wasn't big enough. Finally, for the strong up move to 12 ringgit 32 cent, the upside movement is about 10.4%. The call payoff is 12 ringgit 32 cent minus 11 ringgit 16 cent, which equals 1 ringgit 16 cent. The put payoff is 0. So the total payoff is 1 ringgit 16 cent. Subtracting 70 cent gives us a profit of positive 46 cent.
Now, I'll be breaking down the payoff dynamics of our long straddle strategy, which carries total premium entry cost of 70 cent at an 11 ringgit 60 cent strike. Looking further at the bearish scenarios, under a strong 10.4% market drop to 10 ringgit, our put option goes deep in the money, yielding a clean net profit of around 46 cents. However, a moderate drop to 10 ringgit 80 cents results in a 34 cents loss because the movement isn't strong enough to offset our premium cost. This proves that minor volatility is a trap. Moving to slide 2, we see the strategy's ultimate worst case scenario, a completely flat market. If the stock prices stay exactly at our 11 ringgit 60 cents, strike at expiration, both options expire entirely worthless. We recover nothing, resulting in maximum loss of our entire 70 cents premium. Because we are long volatility, market stability is our absolute biggest enemy. The bullish side perfectly mirrors the downside. In scenario for a minor upward drift to 11 ringgit 52 cents isn't enough to cover the double premium drag, leaving us with another 34 cents loss. But when we get an aggressive 10.4% breakout, rally up to 12 ringgit 32 cents, the call option takes over, securing us a strong net profit of 46 cents. To summarize, the math shows our lower break-even point is 10 ringgit 46 cents and our upper break-even is 11 ringgit 86 cents. This creates a strict performance matrix. We only profit if the stock breaks out more than 6.3% in either direction. If it gets trapped within that plus minus 70 cent zone, the trade fails. Ultimately, the high cost of buying two premiums simultaneously creates a massive non-profit dead zone. Therefore, this strategy should not only be deployed when a major external catalyst guarantees explosive market movement. Thank you.
This chapter discusses the option strategy dashboard that was developed using Microsoft Excel to simulate the payoff and profit or loss outcome of the long straddle strategy applied to Malayan banking Berhad, or more known as Maybank shares. The main purpose of this dashboard is to provide a simple and interactive platform for users to analyze how the long straddle strategy performs under different market conditions. In this particular dashboard, users are required to enter several important parameters such as the current stock price, the strike price, call option premium, put option premium, and also time to maturity. Once all these values are entered, the dashboard will automatically perform these calculations. The dashboard calculates the payoff for both call option and the put option at expiration. For the call option, the payoff is calculated using the formula stated in the slide here. This means the call option will only generate profit when the stock price is at maturity is higher than the strike price, whereas the put option, the payoff is calculated using the formula here, this means the put option becomes profitable when the stock prices falls below the strike prices. Next, the total payoff of the long straddle strategy is obtained by combining both the call and put payoffs. After that, the total premium paid is deducted to determine the final net profit or loss. In addition, the dashboard also provides a payoff graph. The horizontal axis represents the stock price at expiration, while the vertical axis represents the net profit or loss. This graph helps users clearly identify the break-even points, maximum possible losses, and potential profit zones of this strategy. Overall, the Excel dashboard serves as a simple yet effective tool for analyzing the performance of the long straddle strategy. By combining numerical calculations with graphical visualization, users can better understand the risk, returns, and the effectiveness of the strategy in different market situations. Thank you!
Next, the long straddle strategies works best when Maybank's stock price moves a lot, either up or down. To make profit, the stock price must move beyond the break-even points, so the investor can cover the premium cost and earn the returns. This strategy also works better when market volatility is high and option prices are reasonable. For Maybank, events like interest rate announcement, earning reports, or economic news may cause strong price movement in the market. If the stock price increases sharply, the call option can generate profit. On the other hand, if the stock price drops significantly, the put option can help the investor earn profit instead. Overall, this strategy is suitable when we expect big market movement but are unsure whether the stock price will go up or down. However, the long straddle strategy also has some limitation. First, the strategy is expensive because investors need to buy both call and put option at the same time. This means that the total premium cost is higher compared to some other option strategies. Second, if the stock price does not move much, both options may expire and cause losses to investors. The strategy is also affected by time decay, where the option value becomes lower at time passed closer to the expiration date. In addition, if the actual market volatility is lower than expected, the strategy may not perform well. Therefore, good timing, strong market movement, and accurate market expectation are important for this strategy to work effectively.
Next, for strategy enhancement, the long straddle strategy should be used during major events such as the interest rate announcement or earning releases, because these events can create a significant price movement. The strategy should also be entered when implied volatility is relatively low. This is to reduce the premium cost. In addition, option maturity should match the timing of the expected event to reduce time decay. Position should be actively managed by locking in profits early or cutting losses when necessary. We also consider the long straddle as a lower cost alternative when option premiums are too expensive. Overall, this project helped our group apply financial derivative concept to a real market situation involving Maybank. In addition, developing the dashboard improved our technical modeling and also payoff visualization skills. One of the main challenges we faced was selecting the most suitable strategy, as different strategies carry different risk and also return characteristics. We also had to ensure the dashboard accuracy because small formula errors could affect the overall payoff analysis. In addition, coordinating tasks and managing timelines among group members was important to complete the project effectively. For future improvements, we would include more advanced scenario analysis involving changes in volatility, interest rate, and also option premiums, as well as compare alternative option strategies to strengthen the overall evaluation. That's all from our group. Thank you.